Okay, so we're going to talk about PE for non-PE people. So some of this I'm sure most people know, but I'm making really doing a comprehensive look. So what is private equity? So the way I start is private equity is in a very broad sense everything that isn't public. Although I'll use the term non-public equity for the purpose of this slide. We all know about publicly traded, but there's a whole class of private equity or non-public equity, different forms of investment. Entrepreneurs being one that we all know. Angel investors are small investments, seed investments. There are angel investing groups in this area. I know that several Beacon members are part of one. We provide seed capital for businesses just getting started. Venture capital is a class of investment where you have companies that require a lot of cash up front. They're not income producing. Biotech being an obvious one here in the Philadelphia region, where you need a massive amount of money for an investment that hopefully will pay off on the back end. The players in this space tend to be very rich, and it's a very long-term item with no assurance of success. And then we have private equity as it's generally used. Private equity as generally used is what we know as private equity firms are companies, firms that set up funds that invest. They're investing for income, and they're investing to sell in a 5-year period. They tend to buy businesses that have established profit records. I do want to mention a couple other investments just for completeness, investment vehicles. One is the so-called family office. A family office is an organization that's set up to benefit a family. The one example I would use that I know a bit is the Bessemer Trust. Bessemer Trust was set up by a guy named Phipps, who was Andrew Carnegie's CFO. It was set up in the 19th century. The fifth generation, Ogden Phipps, somebody I happen to know in my PE travels, he's on the board. And so 5 generations, the family office takes family wealth and invests it for long term. So that's another entity out there not a lot of people are aware of. And then there's hedge funds. Hedge funds are people that really set up a fund to invest themselves in existing companies, mostly public companies. They tend to be somewhat more passive, although they can get to be active in a public company, but that's yet a different space. So I did that for completion. The main point here is that private equity is a specific category that we're going to talk about and exclude these other items that I've listed here. So I want to go through a little bit of a brief history of private equity. There are private equity transactions and firms that existed since shortly after World War II, but where we really started to see private equity take off was in what I call the Raiders era in the 1980s. And I don't mean the Los Angeles Raiders or the Oakland Raiders, talking about corporate Raiders. And that was the era where interest rates fell and the stock market took off starting in 1982. And all of a sudden, there was an interest in equity. And then you had Drexel Burnham Lambert with their junk bonds. People were looking for high returns. There was a little bit more willingness to take on risk. You had big acquisitions. You had TWA. You had a raid on Goodyear. You had a lot of companies where these raiders would come in and want to buy out. A huge driver, and I don't want to get too technical here, but a huge driver of all these transactions was the Bradley-Gephardt tax law. This law cut individual rates, which had been 50%, down to 28%. It also cut corporate tax rates from 50% down to 34%. So it was a huge reduction in rates. It helped the boom. Those lower rates are still with us. They've come up a little bit, but for the most part, not a lot. not anything like the 50% rates we had before. However, one of the unanticipated impacts of the tax law was there was an elimination on the personal side of taxes that favored equity. And so what that meant was if a company went into debt, say $1 billion of debt, the value of shielding the taxes, because you can deduct from taxes, went from 22% to 34%. That's $340 million. So simply by floating $1 billion of debt and returning it to your shareholders, the value of the company goes up $340 million. Well, that's a lot of money. The era culminated in RJR Nabisco, that takeover, which was the largest for close to 20 years. And it's in the movie Barbarians at the Gates, good watch with James Garner. Kohlberg Kravis Roberts, which is still the number 3 firm out there. And then I had a personal experience a week before my first child was due to be born, walk into the office on a Monday morning, and a couple of Texas oil bros made a bid for our company. And we had to end up fighting them off by raising a lot of debt and selling off half the company. We later had a legal action on that, and I got to see some of the documents. And they had bid about a $500 million premium for the company. And that was because they were going to float debt of $1.5 billion, the 34% tax shield. So I had proof that that was what was driving a lot of these guys. Was there was a shift in the economic climate, the tax environment. You had all these rewards. So the PE value then was financial engineering, or what was called paper entrepreneurship. Those rates and that fundamental debt advantage structure is with us to this day. And it's why you have high debt and high risk and high payoffs, because the federal government set it up that way. They tax advantage debt. 1990s, you had a public company boom. You had what I call the anything.com era. drcoop.com, toys.com, anything.com. It was massive. There was a large-scale restructurings that were done. Company I worked for was bought out by private equity, September 12th, 2001. That was an interesting date. Goldman Sachs, they bought us, they raised the debt, they ended up selling us. My first brush with private equity. That era, the public company boom, Enron really messed that up. Because what did we get? We got Sarbanes-Oxley. We had an equity boom. And now you started to see private equity firms come about. Why? Why was it so strong? Because the change in the environment with the government regulation on Sarbanes-Oxley, okay, it now became much more costly, much more onerous to become a public company. It had been progressively working that way back into the late 60s. But really, Sarbanes-Oxley made it, we don't want to deal with that. To this day, I want nothing to do with being in a public company. I don't want to have to do Sarbanes-Oxley. So that meant if you wanted to raise money, the private route was the way to go. And then, of course, we had the downturn, 2007, 2010, and interest rates went to zero. Now you've got cheap debt. You've got a flood of liquidity with quantitative easing. And you had a lot of people with a lot of cash on their hands. They're looking for better returns. You're not getting returns on debt, right? So what do? You want to get into equities, and you want to get into private equity because the public piece, again, there's more and more companies are avoiding the public market. And then in the last couple of years, we've had interest rate increases. Now it's harder to get out of PE. We've had a bank failure, Silicon Valley Bank. I can tell you as a CFO who had 8 figures in cash in Silicon Valley Bank, that wasn't fun at all. Shakes people up, shakes up investors. So where are we? We're in an era where financial engineering isn't enough. You really have to be on your game in private equity and actually create value. Jess, any questions pop up to this point?
We don't have any questions in the chat so far, but as questions arise for folks, please submit them there for Glenn.
So, wanted to give a little overview of one particular PE firm I'm a little bit familiar with to show you where we are with PE. I went through the history and the raters and massive buyouts of companies in the billions of dollars, and that gets the headlines. But a lot of what PE does is on the smaller end. When you're an entrepreneur, for example, and you want to sell, one route you have is you can sell to a PE firm. You get a good value, and there's a lot of firms that will bid on your business. There are tens of thousands of companies out there that do critical work that are purchased by PE, what I call first stage PE, right after an entrepreneur. They're given capital and they grow, they can expand. So here's a firm, Riverside Company. They're a little unique in that they're a large firm, but they only do small investments. They've had 1,000 investments over their lifetime. They have 76 active. A typical PE firm might have anywhere from half a dozen to a dozen companies. They've got 76. It's massive. They have offices in the US and Europe, and then in Singapore and Melbourne. Big operation, but they're small companies. And I've got some examples here of the different types of businesses. There's an animal feed business, bicycle components. HydroCorp is a company that tests and works on preventing contaminants in our drinking water supply. We all know that PFAS are a risk to the water supply. It's a growing area. You've got It's Just Lunch, which does offline dating, not through a cell phone. I'll point out that they've had that investment since 2006, which is a long time, so maybe offline dating isn't that popular anymore. You can see that there's People Grove has software solutions to do mentorship communities for alumni and students. Life Science Education, Red Nucleus. If your cabinets are dated and you need to sell your house, there's a Cabinet Depot company out there that does ready-to-assemble cabinets, so you can do it yourself if you're bored. This is just to give you an idea of how many different companies and how much is out there that these companies do. Riverside Company has a really good process for identifying and finding these companies. So how does PE work? So we're going to get into the nuts and bolts of how PE really operates in the modern era. A PE firm will create a legal entity called Fund X, Fund 1, Fund 2, Fund 3. If you keep being successful, you keep creating new funds. It can raise capital. A typical amount for a fund might be $500 million. A lot of money. You raise this from a variety of parties. The PE firm in the second step will then buy up the companies. It will identify and purchase investments, portfolio companies. That first phase, in theory, is 5 years. You have 5 years to get in. You raise the money, and then within 5 years, you want to acquire companies. The third step is to increase the value of those companies. It's the least glamorous step, but really the most important. And then finally, you sell to either a strategic buyer, somebody in the industry of that company, or to a financial buyer, somebody else who will come in and do it for a future play. You get the net proceeds, you get cashed out, and then the fund's dissolved. It's an illiquid investment. You put your money in, you can't expect it back for 10 years. Now, as companies are bought and sold, the fund may issue dividends, the fund will pay money out. It's all capital gains, long-term capital gains, so it's tax advantage. But once you're in it, it's very difficult to get out. You can, on occasion, with the approval of the fund, sell your interest in a fund to somebody else, but you can't assume that. So anybody investing in PE, you have to be willing to let your money sit there. Because it's illiquid and long-term, the returns generally tend to be high. Although the secret is that there's not really good data on private equity returns since it's private. And nobody really knows. There's studies out there, but nobody knows how profitable it is, which is kind of interesting given the success rate of PE. So the first step, fund creation step. You legally set up the fund. Lawyers make a lot of money off PE firms right from the beginning. You have a fund strategy. So every fund, if you look at their website, will tell you this is where we invest, this is our geography, this is how big our investments are, here's the industries we do, maybe ESG considerations are important. Every fund is different, and that guides what they invest in. The raising money part, of course, is the critical step. So where do they get the money from? High worth individuals are how this game used to be played. You could be a connected person like former Treasury Secretary William Simon, put in a couple $1 million, get a few other people, you buy Gibson Greetings, you then flip it and sell it, and you make about 100 million. That's a nice return. That was like in 1980. It's not so easy now. And even high net worth individuals don't contribute enough money. So it has shifted. The money comes in now from private equity, from public and corporate pension funds and endowments and insurance companies, sovereign wealth funds from nations around the world that have a lot of money. The family offices I talked about. And a recent innovation is a fund of funds, where there are funds out there that invest in private equity funds. So you invest in the fund of funds. I put at the bottom one-time event. When you create the fund and you raise the money, you're done. It's closed. You don't accept additional money. So it's not like normal markets where money can come in and come out. The fund is there. You put the money in, that's it. It's locked away in the fund until it comes out. And a fund will not raise additional money. Now the tough part, one of the tough parts, you have to now go out and purchase the portfolio companies. You develop your target criteria, which is, what are we looking for? What are our criteria for whether we invest or don't invest in the company? I would suspect all PE firms are looking for two things, and I'll have different percentages that they're looking for or different specifics, but they want top line growth. They're looking for growing companies. They have an acceptable risk of investment loss. I probably should have added in there, they do want an earnings record. They're going to look at the earnings, although the earnings will drive the purchase price. If you don't have an earnings record, they're not interested. They're not venture capitalists. They're not angel investors. They want a business that's producing. You're going to identify the targets. Often they're closely held targets. They are companies that you don't really know that they're out there necessarily. Company I work for makes all the plastic labels for Smart Water. You're not going to know where they are. Do you know that they're in Connecticut and they've got this little, but no, nobody does that. You have to go out and hunt and find these companies. A lot of research involved. In the PE firm, you will have a lot of partners, a lot of people that put together the fund. There will be a lead partner selected for each target, generally someone who knows something about the industry, has an interest, or it could be geographically based, but you have a lead partner. A lead partner is very important because it's their investment. And the people aspect is extremely important in PE, and we'll talk more about that. And once you identify a target, you have to put together an investment case. Little presentation. Here's a forecast. Here's a write-up of the business. Because you have to present it to the firm, other partners in the firm. There'll be a lead partner and there'll be a review partner. It'll say, well, why should we invest in this? To keep you honest. And that investment case, you have to have a financial forecast. You're going to put in numbers. Value in private equity is set by what we call adjusted EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. It's the closest thing you come to a cash generation from accounting records. And that's multiplied by a multiple. The multiple could be 3 times, 10 times, 20 times. How attractive is the industry? How fast is it growing? Certain industries are more attractive than others, carry a higher multiple. Okay, if you're a lumber company and you're chopping down trees, that's not going to be the same as if you're in biotech, for example. So the industry attractiveness is important. How fast are you growing? And what's the overall economic environment? The multiple you can't do much about internally. You can control to some extent the earnings and make adjustments for that. But that formula is what drives the valuation. And that's critically important through the life of the investment. Then you'll set up an initial purchase price agreement. You'll do the due diligence. Really important step, because the selling company, you've got their records. Sometimes they're entrepreneurs. They may not have really good records. They may not have disclosed everything, and you have to try to find everything about the business you can. You want to put together a value creation plan, which is how you're going to increase value, which I'll talk about below. And then you get to the point where you have to set a price. You adjust your price based on due diligence. If you find problems, the price comes down. And then you either negotiate if you find problems, or you walk away. Sometimes the walking away is painful. You got a deal all ready to go, and you got a guy in Philadelphia that's waiting for the deal to close, because I would have had to spend 3 months in Hollywood for an investment. So I would have been hanging out in Hollywood for 3 months doing some nice work, and the deal busted. And I ended up in Connecticut. So, but those busted deal costs are painful because they're just a complete loss. So the bias is you go through with the deal. Sometimes if you see yellow lights, sometimes if you're really excited, there might be a red flag and you still go through it. Sometimes you work through those problems, sometimes you don't. Then you close the deal, you finalize your lead partner. You have what's called a portfolio company. They're part of your fund. So I'm going to put this chart up for a second and then pause to see if there's any questions. The chart here shows how the fund works. The fund's the central part of private equity. It's a pool of money that sits there for 10 years. Private equity firm usually puts in a little bit, 1 to 5%, and they're the general partner. They manage the deal, and then all the limited partners, all the people you raise money from, they own it. And there you are. The fund itself owns the investments. So that's the structure. Now, the overriding concern of the private equity firm and the lead and the limited partners is we've put in this money, and 10 years later, we want a lot of money back, and we want more money back than we put in. So how do you do that? Value creation. When you buy a portfolio company, you have a value creation plan. For some investments, the value creation plan is in people's heads. They've got a general idea, oh, we'll do this, we'll do that. It's a little casual. I've often also seen 2-inch thick books. So it's like when Andy Reid went to get his first head coaching job. He walked into Jeffrey Lurie's office. He had a 2-inch binder of all the things he was going to do. Blew Jeffrey Lurie away. Andy Reid's been reasonably successful. But there's a lot of thorough work that really needs to be done. Sometimes it's done, sometimes it isn't. You have to cover everything about that business, not just the finance, which is the thing that private equity funds mostly concentrate on. You've got to cover everything. What are you going to change? If you buy a company with an entrepreneur, a business founder, are you going to keep him or her? Sometimes you plan to keep them, and then you find they can't make the adjustment to working for private equity. Not really often a fit with an entrepreneur type and being within private equity. More often than not, I've seen it where that person has to leave. So what are your plans if you're going to have a CEO, or what are your backup plans for a CEO? To what extent do you need to build out the staff? Because PE runs a little differently. They have different requirements. Do you have to build out the staff? Do you have investments you have to make internally? Are you going to grow? Are you going to offer equity and change the staff compensation? You have to look at all the back areas that can burn you. HR. You know, I've seen people say, oh, we don't need to check out E-Verify or see if our employees are legal. That can get you burned. IT is massive. Risks keep going up. Compliance keeps going up. You really need to check into that. Is the business insured? And entrepreneurs, for instance, will often are kind of cowboys. They don't worry so much about risk. You're a PE fund and you have something horribly go wrong and you aren't insured against loss. That's going to be a difficult meeting with your investors. There's property considerations, environmental considerations. You really have to assess risk because, again, one of the fundamental criteria that I mentioned earlier is you cannot lose the capital, the investment capital. The return on investment is very important, but at the very least, you want to have a return of investment. If you don't even get the return of investment, that's bad. So that risk assessment is critical. So you should document all the items you want to change and adjust that document. And then after you buy the company and you've got your people in and you're looking it over, adjust that document. If you do this properly, a firm can accelerate onboarding. In other words, if you have a template, if you have a certain way, so talk to these benefits people, talk to this insurance company. If you've got a nice structure, you can quickly bring a company up to speed and professionalize it. I've seen it done that way. I've also seen private equity firms wing it or just leave it to the portfolio company executives who maybe just came on board. Now they have to do everything from scratch. Most important thing at the bottom is to be realistic, and this is the one that burns everybody because it's exciting to buy companies and have all these growth plans and put growth on spreadsheets and see all the profits you're going to make. But oftentimes it's not grounded in reality, and you're not looking at downside, you're not looking at risk. One of the major issues you have is a PE firm will want you to change, will want you to grow, want you to expand, but they also want the income. Well, if you make changes and you're growing, that can often affect your income in the short term. In theory, that shouldn't matter. As we see when we go further on, in theory, that should work out okay. In practice, it doesn't because of the human factor. And I'll talk about the human factor here in a second, the human part of private equity. So the PE firm interacts with the portfolio company. So you're sitting there, you're in a portfolio company, you're an executive, you're in upper middle management, you have some contact with the PE firm, the lead partner. You talk to that person a lot. And the lead partner is always interested in what are the add-on investments. If we bought your company, oftentimes what will happen is that the company will expand either geographically or into different product lines. So we're going to do add-on investments to make it bigger. You're going to be talking with them about that. Any major decisions involving the company, you'll talk about it. Strategy, they're looking at it. Why? Because that PE firm lead partner, that's his investment. And he has to answer both within his firm and to investors. So his credibility is on the line with the portfolio company. That's the human piece. If your profitability slips, you're going to hear a lot more from that person for that reason, because their personal credibility is on the line. A PE firm has what's called operating partners. Operating partners are industry experts. They tend to be older people who know the industry, and the PE firm retains them, and they help the PE firm as almost like consultants. They go around to the different companies. They work with the operating management. You also have financial experts within the company. They may be called operating finance partners or just their finance people. They tend to be ex-CFOs, that sort of thing. And what they will do is work with your financial people to understand what's going on. They're there to provide help, which, as I wrote on the slide, sometimes that's helpful. Sometimes it's like, oh, geez, they're going to come and spend a week here and I've got work to get done. So it's very easy to overdo the help piece. You will have a board that you get approvals from. And then the PE firm will at times need to invest equity, additional equity beyond the purchase price. The PE fund will leave some dry powder after they buy the company. They will have additional amounts in the fund. They want to be careful with that because if it's not invested, you can't get a return, but you don't want to lose all your dry powder in case you need to support your portfolio companies. So that's a judgment call. So there's only so much of that dry powder to go around. If your additional equity needs are for an acquisition or growth, that's a good thing. If it's because performance is bad, that's going to be tough for the people running the portfolio company because now you've used up dry powder because the performance isn't there. Sometimes the performance slips because of industry conditions or events beyond the control of management. The PE fund and the partners may or may not be sympathetic. It probably depends on how much dry powder they've burned up as to how sympathetic they are and how much pressure they are under. So the people aspect, the personalities of the people running the PE fund, and the fact they have to answer to people, that becomes extremely important. And that's the human piece. Different PE firms have different sensitivities. Some are larger, can absorb hits. If it's a KKR, for example, and they take a hit, they've got a lot of dry powder. Overall, as a firm, they can always ride into the rescue if they have to. They'll call another part of their business and provide some emergency funding. If you're a smaller fund, you don't have that. And then, of course, it's not only variation among the PE firms, but also the personalities of the people involved. So it's difficult to generalize. Reporting. This is really a massive undertaking for any company. Most of us are familiar, have heard of public companies. You have reporting to the SEC, you've got Sarbanes-Oxley, you've got all these other reports that you have to do. Those companies tend to have large staffs for compliance, for the accounting, for the reporting, etc. In a PE portfolio company, you don't have that, but you do have quite a bit of reporting responsibilities nonetheless. Again, getting back to the people part, every month a PE firm will have a portfolio review. So I said the typical firm has 6 to 12 firms. A firm like Riverside has 76, but if we stick with the 6 to 12, they'll have like an all-day meeting or maybe 2 days of meetings where they will review every month how are each of these firms doing month by month. Okay, it's a 5-year investment, right? It's long-term. No, they're looking at it every month. So that means every month you've got a lot of reporting that the company has to do to feed these meetings. At least every quarter, the PE firms will have to meet with their limited partners and report on progress. So that means from the standpoint of the portfolio company, you'll have your deep dive board meetings. You will then have reporting that is set up for these investor meetings. Obviously, performance, how you're doing, influences how many questions are asked and how thorough the preparation has to be. You have banks. When you get the investment, when the portfolio company invests, they usually use a considerable amount of debt, have since the 80s, as I said. Means you've got banks involved. It's almost always banks. You have to answer to those banks at least monthly, sometimes quarterly if you're lucky. So you have detailed reporting you have to do to show that you've met their covenants. Do you have enough income to cover your debt? Do you have not too high a level of debt relative to the size of your firm? And you have to meet those covenants, or else if you break the covenants, then the bank could come in and ask for refinance terms, charge you fees, or they can, in extreme cases, take over the company. So you have to keep the banks happy. If you have what's called asset-based financing, which means you're also borrowing money, revolving line of credit from your accounts receivable and inventory, the reporting can be weekly. Every week you have to report your receivables and inventory. It's a lot. If your performance falls short, now the oversight increases by an order of magnitude. Now they are all over you. And of course, if you're struggling and having performance issues, you want to spend more time fixing the issues, but you have the reporting oversight. The reporting increases. And now instead of a board meeting every quarter, you might have it every month or every other month. You'll have people show up. Okay, explain to us what's going on. Meanwhile, you're trying to run the business and get it back on track. So one of my fundamental points, the idea that PE is not concerned with short-term performance is a myth. It's not true. They are highly concerned about short-term performance because the lead partners have to answer to the investors. Your bank relationship manager has to answer to their credit committee. And they are all looking at things short-term, month to month. Whether they should or not is a separate question. Whether they overreact or not is a separate question. The fact is, from a people standpoint, people are concerned if it's a bank, for instance, and your performance slips and you're violating covenants, that's a risk to the bank. That's one issue. But in my way of thinking, the people aspect is always more important. So how does the people aspect come into the bank? If a company is underperforming and violates certain criteria for investments, the federal government, the Office of the Comptroller of the Currency, requires the bank to write down the investment. Like they loaned you $50 million, so you have a $50 million asset, you're collecting income, everything's fine. Now the requirements tell you you have to take a $20 million write down because it's underperforming. That hits current earnings, which means it hits people's bonuses at the bank. It's personal. Now they're pissed because they're not getting that bonus. I had a call one time from a banker who was in just a tremendous mood. I'm like, what's going on? He said, how you doing? I said, oh. Why are you so happy? He said, well, we had a review and we determined that your company's performance has improved and we were able to reverse the write-off. So we're now looking at a huge write-up. It increased our profit, and now we all made our bonus targets. So they were very happy with us. You can't underestimate the personal impact on people. I mean, we talk in business a lot about the numbers and the performance and the rates, but it's the people that are involved. That's what drives things. So my last point on this slide is the pressure in PE is at least as high as at a public company. In my experience, more so because I've worked for both. 25 years in public and 15 years in private. Public was a lot easier. It's tough, but it's also can be very lucrative and very successful. So the best part is when it's harvest time. You've increased the value of the company, and now you want to cash out. You want to identify when is the right time to sell. I showed It's Just Lunch a little while ago. It's 2006. They invested. 18 years later, they're still in the investment. They haven't had a right time to sell yet. That happens sometimes. Investment hangs because it's just not marketable. What are you looking for? the business looks for is that valuation. You remember the EBITDA times the multiple. Well, they're looking at the last 12 months of your earnings. What have you been doing over the last year? And then we're going to put a multiple on that. So what happens is the timing can be critical. I had a target to sell a company in December, or to start the process of selling in December. November, December were disappointing. January, February, March, disappointing. By this time, the firm PE guys were very upset. And then we just took off. April was great. May was fantastic. Everything was turning around. In June, we made a decision, okay, sell. And we had the deal closed by October. You just can't predict this. You cannot predict the sale. The company I talked about previously, I don't think I mentioned the company's name verbally, Cognos, which was a chemical carve-out of a soap company in Europe, global company. Goldman Sachs had 50% of the ownership. They went to market, put it out on the market. They had themselves another branch of Goldman Sachs. They're investment bankers. They're among the most savvy in the world, right? Sale failed. I mean, they couldn't sell their own investment. So the best and the brightest, the slickest operators, the guys that everybody looks up to, they couldn't get it done because things can go wrong very quickly. It's high stakes, and you don't know one day the next what's going to happen. I mean, if Goldman Sachs can have a very public fail, it can happen to anybody. So what that means is you have to be ready to go. You have to be completely prepped to sell at any time because you just never know. You could have a couple of hot quarters, or you could have somebody call and say, hey, we've watched your business, and you're thinking, well, we're kind of doing well, but we haven't really shown anything. And then someone calls and says, hey, we'd like to buy your business. Well, you have to be prepared. How do you prepare? You get a broker. Brokers are these companies, these investment banks, and they make a lot of money, even more money than lawyers, which is saying something. And they will help you pitch your portfolio company. And it all falls on the portfolio company people to do this, not the PE firm. PE firm will give you some advice, but you have to have your documents. You've got to have, as I said earlier, on the due diligence, you cover everything. You have a management presentation on your growth. You talk about your business development. You talk about your manufacturing or your procurement. You talk about technology. You talk about, finance. In the end, they'll hear the story and go through everything, but you've got to have your finance together. You got to have your numbers together. And that be ready to go means you better have your documentation. You better be airtight. Because you will make all these presentations. You'll have a deck. You'll have 4-hour meetings. I went through one time. We had 12 different 4-hour pitches that we went through. And then they bid and you pick a winner. We're going to negotiate with these guys. They say, okay, here's the price ruling to play. So you pay that price. And then due diligence hits. So I got my controller and I sitting there, and they bring in 7 guys from Midtown from a major accounting firm that are valuation and accounting experts. And we had like a 6-hour examination of everything. And they pick and they are looking to find holes. So you're under tremendous pressure that you don't want to leak value. Because as I said on the purchase end, when we were buying the portfolio companies, you send in the due diligence, and if you find gaps or holes, that could reduce the value, or they could walk away. Because if you disclose something and you're upfront about it, you're cool. All right, they'll look at it and say, okay, we get it. If you didn't disclose it and they find something that's off, or they find your numbers don't hold up, now they're going to be suspicious. So not only will you lose the value from whatever hole you've got or whatever gap you have a credibility loss, and they will hit you for that on top of it. Again, the people aspect, and rightfully so. So it is extremely important that you are thoroughly prepared. How does that affect everybody? Well, that means the entire firm across the board, you've got to have your act together. You've got to be able to answer questions on just about any aspect of the business that comes up. A lot of pressure, because if that sale fails, you're a portfolio company executive and you've got a huge incentive. And I can tell you, you get cash and or stock incentives with a successful exit, and you blow it, all the work you've done, forget it. You're out, and someone else is going to get paid, not you. So if you do it correctly and you sell the business, it's very simple. They get the cash, the wires hit, and then the fund, one by one, sells its companies. Occasionally you get a company that you can't sell, like the It's Just Lunch 2006. You have one or two options. You keep that fund open. Now, again, those people wanted the money for 10 years, and now you're going on 18 years and that fund's still open. Or what you can do is, a recent innovation is, if you have Fund 4, let's say that your investment's in Fund 4 and it's been going on forever, you might have a later fund buy it. Now, again, that's a wholly different group of investors. That's a different group of people. So if Fund 6 is going to buy from Fund 4, Fund 6 is going to say, wait a minute, you've had this investment, so how long, why should I buy it? Price is going to go way down. It's a way you can manage it, but it's very tough to do. So if you get one of those investments that's difficult to sell, it presents a huge problem for the PE firm and points up to the importance of that initial acquisition, because it's illiquid, and illiquidity is a huge issue. Any questions, Jess?
There is one question that was submitted, and it's asking for your thoughts on ignoring sort of sunk cost upfront versus expectation of return on investment, and how you manage those expectations.
Okay, I'll take a guess as what they mean by sunk costs, but because I'm not sure what context that is.
Glenn, it's Susie. I'm the one who asked the question. So earlier you were talking about red flags, yellow flags might come up when making an investment, but they usually barrel through that in favor of making the investment. And then a little bit later on, you talked about the expectation is to at least get the return, the investment that was made back. So I just wonder if there's, if sunk cost is something that might periodically bite them, or.
Okay, thank you. I think it's, I often use, I find it's part of the human experience, right? Where there's the intellectual side of our brain, where we can process something very quickly and know we're in trouble or we've lost something. And then there's the emotional impact. For instance, you're ready to sell a PE-owned company. You're all set to sell. It's on track. You've got the broker you started, and then things go south and you have to cancel the sale, and then the management team gets removed. I've gone through something like that. You can instantly process that, the reasons, the logical reasons why that failed. It's not so easy from an emotional basis. You're so close, and it's not just that you lose the money, it's that you were ready to succeed and you failed. You lost a big game and it cost you money. That's hard to deal with. You know you lost, but you're in the locker room after the bad loss, and you know exactly why you lost, but you're going to feel it for a long time. Bill Walton, the basketball player, said he lost a game, and 40 years ago, and it still hurts him when it broke a winning streak. It still hurts him to this day. So there's that emotional thing, which is the Beacon presentation. The reason I'll say it this way, Susan, is in the PE firm, they've got to process the emotion. And they've got to process the reaction. They can intellectually get it, but sometimes the emotional reaction, and different people have different ways of processing and have different timetables. it's a hyper-realistic business. In the end, you have to write down the investment. You have to do what you have to do. Sometimes the emotional reactions can lead to bad decisions. But the really good operators, I knew one guy that would scream and yell and he'd be all upset, but he was really good at coming to the right decision and doing it quickly. I mean, he'd blow off steam, he'd get all upset, and then, okay, next day, let's move on. I'd rather have that than somebody that gets caught up and can't get past it. So the answer is, and I keep coming back to it, it depends on the people. It's a people issue. It's how do people make decisions? The numbers and the analysis, we have all of that, but it's the people that make decisions. And there's no way you're going to know that ahead of time. You're not going to know how people react until they see you react. So I've seen different executives, different PE partners make different decisions, and it can be based on emotional issues because they're all highly, highly intelligent. Emotional intelligence can vary a bit. I'll just leave it at that. I hope that answers your question.
We have another question for you, Glenn, in the chat from Stephen Rosen asks, how are the fund managers compensated? And if there's a write down, is their compensation affected? Likewise, if the IRR is low, do they earn less?
So the partners have investments are often compensated based on the performance of the portfolio companies. That's a huge impact. The PE firms themselves will sometimes take what they call management fees from the portfolio companies. So you pay the PE firm, not the investors, but the firm, a management fee for the pleasure of having them manage you. So it may be $50,000, $100,000 a month, and you pay it to the PE firm. So the management fees, that can affect their compensation, but oftentimes you'll have some firms don't take management fees. They wait until the investment goes. So they're totally based on the investment. I mean, they do have a base salary, but they are heavily incentivized for the performance of the fund and performance of the portfolio companies. So that is without question, it's a huge part of it. But I would also say that a huge part of it with the partners, the principals in the PE fund, is that these are all highly competitive people. They're all successful people. They don't like to lose. And when something is not performing well, not only does it hit them in the pocketbook, but it hits the pride. And that exacerbates some of the emotional reactions I talked about just a minute ago. So here's a little bit of my view of the future of private equity. Your views may vary. In my opinion, private equity is here to stay. It's a form of organization that's proven highly successful, and it gets equity capital to growing businesses. Back to my Riverside example and all those companies. There are so many companies out there that have grown and been successful. An entrepreneur reaches a point where they can't spend, they don't have any more money to put in. And since going public is extremely costly and difficult, PE's a way to go. So I think it's here to stay. I think that the legal and economic environment is critical. I use the example of taxation and the tax rates, how the tax rate changes, and Bradley Gephardt in 1986 still fundamentally influences to this day. Obviously, interest rates going up and down make changes. So I have under there watch tax law, interest rates, and other regulations. Because if there's any changes in those, which in the immediate term, I don't see Congress being able to act to change any of this, but you never know going forward where there could be reform or changes in tax rates or different treatments of debt and equity. There could also be regulation of PE funds, or there's complaints about carried interest and some of the tax benefits has to be watched. PE is a legal form. In the end, it's just a way of coming up with a structure for money to flow. I do think that if there are changes, PE will remain, but it will adapt to the changes because it's just too useful and a form to our economy, to growth, to go away. But changes like in interest rates can have massive value impacts. All of a sudden, you've got a lot of that cash that was going into the shareholders' pockets. Interest rates go way up, massive amounts now, because it's almost always for the bank's variable rate interest. It's going out of the pockets of the PE holders. And now it's hard to sell. It's hard to get out and exit and get your target. So these environments can have massive impacts, plus and minus. It's really the interest rate has made a massive difference. What you are seeing is more equity being put into deals and less debt, but then the returns are a bit lower. So it adapts. And back to the sunk cost question, if rates go up and you have to put in equity and your returns are down and your investors take a hit, well, it's hard on the pension funds and the endowments and the other people, but in the end, there's nothing much anybody can do about it. The rates go up, the values go down, and you have to adapt. If you're a portfolio company that was teetering and interest rates go up, you could get weeded out of business. And the same with PE firms. We saw in 2008, 2009, 2010, some PE firms got wiped out. The funds just, the performance was so poor. If you have rates or you have significant problems, the value of a portfolio company investment can crash. And now your fund is out and people are not going to want to invest going forward. And you might have to liquidate a fund and just be done with it. So it's, capitalism, right? In its pure form, there's massive profits involved, but you can get crushed as well. The last point I have is one weakness of private equity is it's somewhat shut out for a lot of individual investors. It's difficult, for example, if you have an IRA or 401k or whatever, how are you going to get in private equity? And yet that's where a lot of the money is. If you're an investor with cash, how do you get into PE? Publicly traded stocks used to be extremely expensive for small investors. And then we had E-Trade and day trading. Publicly traded stocks evolved to where it became more accessible for individuals. I'm thinking in the future, maybe there will be devices so that people could get into PE. Now, it's difficult with individuals. There is the fund of funds concept where if you have, we have index funds, right? It's not practical to buy the S&P 500, but you can buy an index fund. So perhaps in the future, it might be more accessible for people to invest in PE that are not high worth. So I've got, how do you enter PE? How do you want to get into PE? Because I've heard some people say, well, how do I get into PE? So I'm going to take a very, very broad look at how you get into PE. You could be an investor. Currently, to be an investor, one general rough thought was they're looking for people with $1 million of wealth and $200,000 to $300,000 in income as kind of the floor. Possibly doable if you've accumulated the capital and you've got a really high-paying job. Not so easy. And this is why I have for the future, maybe if there's a fund of funds, those numbers will come down and you can invest in a fund that will do that for you. To get into PE and work for a PE firm, it really helps if you're a lawyer or you're in finance, you went to a really good school and you're in New York City. Also, if you're young, that helps too. It's tough to get in to these firms as a firm employee, and they work you to death when you're really young. Another way of getting into PE is if you're an entrepreneur and you've got a good business, it's got income, you can sell it. This is, as I said earlier, a very popular and very common way for entrepreneurs to cash out. Sometimes your business needs management beyond what you could do because it's grown. Sometimes you're older and you want to retire. Sometimes you just want a lot of cash and you want to cash out your business and get the liquidity. What I call the first stage PE firms are perfect. They'll handle this. However, you're losing control. And even though they might hire you on to keep you in your seat, they can kick you out at any time. So entrepreneurs can get in. Another way you enter a PE was how I initially got into PE is your company's bought by private equity, and now you are a private equity portfolio company. That gets you in PE. And depending on where you are in that company, you could get some exposure and get a little experience on it. Another way of entering is you can work for an accounting or financial services firm. CFGI is one that's big in Philly. They're global. They are the largest firm in the United States that does accounting services firm that does not do auditing. I worked for a predecessor of theirs, and that's how I got into it, is doing some services and getting exposure into those companies. You can also be an individual and provide services to PE, but that's a little bit more difficult if you're a consultant, etc. But that is a way to break in. You could become an operating partner. An operating partner is somebody with industry experience. It's somebody who has something to offer. It's difficult if you don't have any PE experience, but depending on the nature of your expertise, it could be an option. Another way you can get into PE is if you are hired or join a PE portfolio company. If you're in the C-suite, you're in, right? But if you're in middle management, upper middle management, that's a way to get into that. You search out a PE firm and get some exposure, and then you can claim PE experience. And then, of course, it wouldn't be Beacon if I didn't have the last point, which in my experience was incredibly important for getting through PE. I've worked in PE or closely held companies for a long time, really going back to September 12th, 2001. The networking is just so important to connect and get into this industry because it can be tough to break into it. And Jess, that wraps up my presentation.
Wonderful. Thank you so much, Glenn, for walking us through all of this incredible information. I have one other question from the chat from Ed Henkler, who wants to know, does a PE firm ever invest in technology or services which might benefit all of their portfolio companies?
PE firms will invest in almost everything. I had a PE firm where I was working in a portfolio company invest in a benefits company. So they did employee benefits. And then all the portfolio companies were required to take them on as their benefits consultant. So it happens. I tend to be more of an arm's length person. Like if it makes sense, then do it. But if it doesn't make sense, you really shouldn't do that because one party gains, the other party loses. But yeah, I mean, if you look at some of the investments, firms will often make investments in service firms. Services are very popular. Or education companies are also very popular. And those can be applied to their portfolio companies or to a lot of other PE firms.
Thank you. Do we have any? Oh, we do have a couple popping in. We have one question asking if PE firms provide common services like finance, HR, or IT to member firms?
Generally not. The PE firms tend to provide and do some of the functions of, say, a CFO because they're financially oriented. They will do, if it's a public company, the CFO has to manage the due diligence, the CFO handles the banking relationships, the CFO has to find financing. A lot of times the PE fund will do that. The PE firms sometimes will have relationships. So they'll say, here's our global partner for accounting or auditing services. Here's our global partner for IT consulting. Here's a partner we use. It's a firm that will consult with you on purchasing non-core items. And we've got an arrangement where they can take some of the non-core purchasing off your hands. It depends on the PE firm. Some are very hands-off, and some will offer a lot of services to help. I think that in my mind, it makes sense for the PE firm to have a template and a general idea and not enforce it necessarily to say you have to use this or you have to use that, because sometimes you'll have a portfolio company where it really doesn't fit. But it's very helpful, much as it is if you're in a large company and you have people taking on those administrative tasks. It's very helpful if the PE firm does that, because you're talking about 100, maybe 50, 100, 150 million revenue business. You don't have the scale to have the staff, and you have all this compliance you have to do, and you're growing. So if the PE firm does that, it's helpful. It varies a lot by firm as to what they do.
Thank you. Do we have any final questions? Feel free to chime in or pop them in the chat.
I will say one thing to re-emphasize, having worked in private equity, Glenn's had a lot more experiences. First of all, thank you for a great presentation, Glenn. Secondly, when Glenn talked about the pressure, it is different. And so you need to come into a PE environment understanding there's lots of opportunity, because the fact you don't have a strong infrastructure can also be a benefit, because you can adapt and really shine in some performance factors. But there is the pressure, and you are as an operating team member, whether C-suite or middle management or on a contract or otherwise. The primary thing is to get a return on this investment, and then you operate the company, but you have to do both. And that is where some of the pressure lies. And so there's definitely opportunity if you can get that connection to have a valuable talent skill that you can share, but it is going to be very demanding. So if you're into wanting a challenge, it can be a good opportunity.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.